Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi audience, this is James Kandasamy. You're listening to Achieve Wealth podcast through value-add real estate investing. Today we have an awesome guest. His name is Nikolaï Ray. Who's the founder and CEO of MREX, which is an acronym for Multifamily Real Estate Exchange. He's considered by many of his peers in North America as the leading expert in apartment investing with over $1 billion analysis, underwriting, and transactions. He's also a pioneer in mid-cap multifamily financial engineering, which is, he's regarded as the teacher, advisor, and also the keynote speaker. He's also a real estate tech innovator through his current work on the multifamily real estate, big data, artificial intelligence, and property tokenization using blockchain technology. Hey, Nikolaï, welcome to the show.
Hi, James. Thanks for having me.
Okay, so do you want to mention anything that I missed out about your credibility?
No, that sounded like a mouthful.
It's going to be a very technology-centric discussion today, right?
Yeah, the full story of that is actually probably a lot longer, but I mean that could be for a whole other episode of the origin story of how you get to where we get in life and
Sure.
both professionally and personally. But yeah, that's the gist of it. Everything that's underwriting and acquisitions, dispositions, refinancing, obviously portfolio management, whether it be the small cap market, between 5 and 100 units, all the way up to the mid-market, market cycles. And obviously I have a very strong penchant for data and for technology. So that's pretty much what I've done over the last, over the last 7 or 8 years is focused. For the most part, I focused mostly on acquisitions. So I was in charge of an investment banking firm. We worked, on both sides of the transaction advisory side of things for investors, and we also worked with a lot of ultra high net worth investors. That's kind of where I built my specialty. Eventually, ultra high net worth investors and private equity firms and family offices. And by doing all that, I kept on getting annoyed with the fact that the multifamily market is so fragmented, and the data is so opaque. And I just kept on thinking to myself, this market, which is an important market. I mean, the apartment building investment market is almost a $10 trillion market worldwide. It answers a primary need of human beings, which is to have somewhere to live. And yet, we're kind of in the dark ages as multifamily investors because, number one, we don't have access to any centralized marketplace. If you compare, say, to a stock investor who can go on the NASDAQ and trade every type of tech stock, or a stock market investor who go on the New York Stock Exchange, and we don't have access to any data. The data is very raw. It's very, it's kind of, what I call legacy data. If you look at like CoStar and all these various data providers who provide this very raw and inert data without any actual, context around the data and without any helps with regards to making decisions, business intelligence-wise, as a multifamily real estate investor. So that's kind of how my career has gone so far. That's why I went from transactions and more towards data and technology, because I felt like there was so much work to be done to help investors just, be better investors, pretty much.
Okay. So let me understand MREX because I think it's important since you have a lot of passion in it right now.
Yeah.
Multifamily Real Estate Exchange, if I understand it correctly. So what you're saying is right now, the data is so fragmented. And a lot of times when, people like me underwrite deals, we have to do so much of work. Every deal I underwrite takes like 3 to 4 hours because I need to pay all the property management financials, and there's so much of mistakes in the property management financials. You have to do T3, you have to do T12, you have to do expense ratio, you have to do market comps and all that. So what you're saying is you are going to summarize all that and make it so easy to look at so that it can be traded as a commodity. Is that right?
Not necessarily. So the idea is taking you as an example, or any of the listeners right now who are multifamily real estate investors actually acquiring properties, let's say you have the capital ready, or your investors have the capital ready to allocate to an acquisition. Just actually finding that first property to buy, or the next property to buy, is a very time-intensive and energy-intensive job, right? You have to go on all the different MLSs. You have to go on the LoopNets of this world, and the Crexes and the 10Xs, and just
too.
Right. And then you have all the brokers, and then you have all the broker websites, and then you have all the pocket listings, and and you have not even really touched the majority of the market. You're actually still missing probably anywhere between 25 and 50% of actual transactable inventory, depending which metro area you're in. So it's a lot of work, even just to look at the stuff that's on websites. That's a lot of work, because you have to go on between 5 and 15 websites. Each website has a different user interface, has this different user experience, and actually shows different information. On one site, maybe on LoopNet, you might have the cap rate. Maybe on the MLSs, you won't have cap rate. You'll just have gross revenue. So then you'll have to figure out your own cap rate off of that. It's a lot of work, and for me, I just never thought it made sense to not be able to say, hey, I want to buy a multifamily property, whether it be a 5-unit, whether it be a 50-unit or a 500-unit. I want to go onto one marketplace where all properties are centralized in a unified and normalized manner, because that's the second point of it, is you have to be able to normalize expenses if you want to start comparing apples with apples and oranges with oranges. So that's the second phase of it. So what we're doing with MREX is we're building a unified, standardized marketplace for multifamily investors, where they will be able to see every single property that exists that is for sale, despite on the way it's being sold or listed or marketed. We're going to be working with brokers. Obviously, the goal is not to get rid of brokers or anything like that. That's not what our goal is. Our goal is to help brokers, help investors, just make the whole transaction process much more quicker and more time efficient. And that way, we're making the market more, just a more efficient market, pretty much.
Okay, got it. So you are basically streamlining the whole selling and buying process, I guess, just to make sure.
Absolutely.
Okay,
Yeah. And the analysis process, as you said too, right? Because it's one thing finding the properties and having them all in one marketplace. Okay, let's say you have the NASDAQ. Let's say I want to invest in tech stocks rather than multifamily properties. I go on the NASDAQ and I can see every single company. I can have access to inventory. Now that's the first step. Now the second step is, once you have access to inventory and the information provided on all that inventory is normalized and standardized, well, I still have to be able to start comparing and start, building my own models to say, well, if I'm a cash flow investor, which stocks are generating the most cash flow relative to the rest of the inventory? So that's where, context and alternative data comes into play with our platform, is that we want to be able to offer data and tools to you as a multifamily investor to help you streamline your underwriting of the inventory that you see. So that's really the two things we're focused on at the moment.
Okay, got it. So interesting. So that'll make a lot of, for investors or for buyers, they would be able to see what kind of deals that they want to buy.
Right.
Matches what they want to get the yield out of it, I guess. Right?
Exactly. And instead of going on 15 websites, well, they'll go on one website. Instead of having to, start normalizing expense ratios and sifting through T12s and T3s and doing all that, it'll already kind of be all chewed up and kind of built up already. So you can actually focus on analyzing, focus on comparing, and establishing, okay, I want to buy this property using this strategy, and why would I do that versus the other property that I see over there? That's ultimately what's the most important thing.
Okay. So couldn't it be a good idea to match this with a crowdfunding platform? Because during the crowdfunding, they can choose what deal they want, right?
Right. So crowdfunding is an interesting thing. The problem with crowdfunding, obviously, crowdfunding has tried to kind of attack two things. Number one is liquidity, right? Because as a multifamily investor, the more properties that you acquire, you increase your net value, right? You're a richer person. But the problem with that is you have to leave equity in every single deal, right? The banks won't finance you 100%. So you always have to leave equity. So as you get richer and richer value-wise, you're actually cash poor because you're leaving so much equity in each property that you acquire. And there's always a part of that equity that has to stay in those properties. But the second problem is that as you become a bigger investor and you acquire more properties and you're more well known in the market, well, you get access to better deals. But now you have less access to more money, even though you're richer. That's kind of the liquidity conundrum of multifamily investors. So that's why crowdfunding is interesting, because it gives kind of, after the Jobs Act, it helps multifamily investors, particularly syndicators, to go and raise capital from investors either through the Regulation CF, and obviously Regulation D 506C was quite an upgrade also to be able to start to market capital raises. But what we're doing is we're actually building a second platform that is shadowing the MREX platform. And what that platform will be doing is we're actually going to create a sort of stock market and take the crowdfunding thing a bit further. Because crowdfunding, as I said, tries to attack the liquidity conundrum. But the problem is that when you invest in a crowdfunding deal, you as an LP are stuck in that deal for the lifetime of the deal. So if it's a 3 to 5 year exit, well, your money's stuck in that. So you as a passive investor or as an LP do not have liquidity. That's one problem. And obviously, crowdfunding also helps with accessibility, right? So obviously, Regulation D 506C is only for accredited investors, which doesn't really help accessibility that much. Regulation CF has helped that because now that kind of lowers the barrier to entry for everyday retail investors who don't have that much money. But it's still a fairly limited regulation at the moment. I know they're trying to pass a couple bills to increase the opportunity for Regulation CF investors. So what we're doing is we're building a second platform that's going to be basically a stock market in its own sense, where through a broker-dealer permit that we hope to get, and then also through eventually an ATS license with the SEC, we would like to be able to take it a step further and allow a multifamily investor to pretty much offer his property through one of the various regulations on that marketplace. That way people could invest as passive investors, as LPs, either through Reg D, Reg CF, or eventually maybe even Reg A+. But then they would also be able to acquire or access a secondary trading market so that they're not stuck in an illiquid period of 3 to 5 years. And they would actually eventually be able to retrade part of their shares or all of their shares, kind of like you would in the stock market.
Wow. So it looks like you are trying to really disrupt the industry, right? So
yeah, definitely. The industry stock, multifamily real estate looks like the stock market before the arrival of the NASDAQ, right? It's like before internet. Even though we have internet in multifamily real estate, it's as if people are still trading kind of like stock market investors were trading on floors, with papers and screaming and doing all that stuff. It doesn't make sense.
Yeah. It's so private nowadays, right? I mean, everybody has private. We do not know how even multifamily is performing under different private LLCs.
Exactly.
There's a lot of good news out there, but there's also bad news, but nobody talks about it, right? So I think.
Oh, right. And the data out there, like look at any of the data from, even from the really big organizations like NCREIF, so the National Council of Real Estate Investment Trusts, NCREIT, sorry. Even their data, when they're all these indexes and indices based on multifamily markets, is based on a very low volume of the actual number of transactions. So when, say, a company, a various data company says, well, the cap rate right now of say Atlanta is 5%, for example. Well, that's actually based on a very small portion of overall transactions. So it's hard for us as multifamily investors to really be sure about the numbers that we're inputting into our underwriting models because we're basing it off so little data.
Got it. Yeah, it is just so limited, right? Because everything's done on a private basis, on a syndication, which is not much of data being published out there, right? So
it's like investing in the stock market, but not knowing how the stocks have performed historically.
Yeah, correct. So But why do you think this would work? And because if you look at the demographic of because I'm looking at syndication whenever we buy from multifamily, but
Right.
for me, it's just a small part of the whole market, right?
Right.
Even though we are, maybe my group or my network thinks that that's the whole thing, how people buy multifamily. I don't think so that's true, because I network with a lot of different type of people, right? So looking at the classes of investors who are buying multifamily, I don't know, for me, my thinking is maybe I am one of the lowest level part of it, right? Because we are buying class B and C using high net worth individuals and all that. But there are a lot of higher caliber people who are playing at a different level, which I don't have visibility. Maybe you have it. So are you trying to look at different classes of investors and cut through all of them, or are you looking at only some classes of people?
So we're trying to help what we call the small cap to middle market investors.
Okay.
So anyone who owns between 5 units and about, I'd say around 2,500 to 5,000 units.
Okay.
That's kind of where we start. That's where we're focusing on, because that, the majority of transactions are actually done by small cap to mid market investors.
Okay.
The multifamily market is historically a mom and pop market. Now it's, it has transitioned a bit. Investors are getting bigger and bigger, but the reality is that the majority of the market is not an institutional market.
Mm-hmm.
At the REIT level or the private equity firm level or family office level, depending obviously which metro area you're in. Right, New York City is obviously more of an institutional market. In Canada, Toronto is a very institutional market, but the majority of cities and metro areas are still, very small cap to mid market. And the problem is that, take you for an example as a syndicator, or even take someone who's not a syndicator, right? Because a lot of investors in multifamily aren't syndicators. They just buy their own properties. They end up with maybe, anywhere between 50 and 500 units as time goes by. Now, the problem with those types of investors and syndicators as yourself is that you do not have access to a team of underwriters. You don't have access to, expensive data that, say, a real estate investment trust has, or that a very big private equity firm has. You don't have access to all those analysts. So, we want to try and make sure that the market stays very level and stays as a level playing field, because, ultimately, I think the multifamily real estate market is very important for a couple of reasons. Number one, everyone talks about the disparity of wealth, right? Of the 1%, and how the disparity is getting bigger and bigger. And we could do a whole podcast on that and why it's happened and where it's kind of going. But ultimately, I think, the multifamily market is probably the market, it's probably the asset class that offers the best returns based on risk, like the best risk adjusted returns, if you look at Sharpe ratios and Sortino ratios and all these things. Now, it's also been proven, there's a lot of studies on this, a lot of university studies done on this, that, social mobility comes from education and access to property, right? The reason why people have been so poor for so long in like the Brazilian favelas or in the Indian shanty towns is because people don't have education and they do not have access to property. They are not able to become landowners or owners of their own homes, even less become investment property owners, right? So I think multifamily stays as a very important asset class, because on top of filling a basic need of human beings, that means providing somewhere to live, it also is a very important mover for the everyday investor, the mom and pop, just the normal person like me and you, to be able to access a very good, a very safe, wealth-building asset class that does not have the same volatility or the same pitfalls as, say, the stock market and other types of asset classes. So I think it's very important that we provide, tools and data and allow for the smaller investor, the investor that has less than 1,000 or even less than 5,000 units, to be able to continue on performing and continue on profiting from this asset class.
Got it. So let's go to a bit more details on some of the big data and artificial intelligence, right? So I studied artificial intelligence almost 24 years ago. Now it has become really popular, like a lot of startups with artificial intelligence, right? So
Absolutely.
first of all, let's define can you define artificial intelligence in your terms, in terms of real estate? Because I studied from an engineering standpoint.
Yeah, well, I'm not an engineer by trade, so obviously I'll give more of a generalist definition to the people listening, which I think is probably going to be very good. The important thing is to understand kind of the difference between machine learning and artificial intelligence. Mm-hmm. So, machine learning is more of it's a less automated process, right? So a lot of what people are calling artificial intelligence is ultimately just machine learning. And what it is that let's say I'm a data scientist or an economist, and I build a predictive model using, say, Monte Carlo simulations. Well, I build a set of hypotheses. I plug them into my Monte Carlo simulation, and then that runs. Now, with machine learning and artificial intelligence, what becomes very fun is, statistics are a funny thing, right? And econometric modeling is a very funny thing because even though, people in the economics world swear by their predictive analytics, the reality is in data science, it's garbage in, garbage out, right? So the outputs always depend on the inputs. So let's say you're doing an underwriting model and you're looking at an apartment building and you say, well, if I buy this apartment building this way, my internal rate of return is going to be 25%. Okay. Now, internal rate of return, net present value, is an output. They're outputs based ultimately on the strength of those outputs are only as good as the strength of the inputs.
Correct.
And the very important inputs that affect, say, IRR and NPV, which ultimately are the two of the most important metrics to help you decide whether to buy a property or not, are rent growth, expense inflation, refinancing interest rate, if your IRR and NPV is based on refinance, because obviously IRR and NPV has to be based on an exit model, and the exit model can either be a refi or it can be a sale, a disposition. And then if it's a disposition, well, your IRR and NPV is based ultimately off the reversion cap rate, so the exit cap rate upon sale. Now, what everyone's doing right now in the multifamily market, especially small investors and mid-market investors, is they're just entering these inputs. They're just playing it by ear, and they're not even playing it by ear. They're coming up with these random inputs that are based off absolutely nothing. I just had a huge discussion on LinkedIn about this with a couple of investors, where one guy was saying, well, if I buy at a 5% cap rate, my underwriting model, what I do is to establish the reversion cap rate, so the cap rate upon eventual sale, let's say in 5 years, is I add 20 basis points to the purchase cap rate per year. So if I bought it at 5 today at a 5% cap rate, well, then 5 years from now, I predict that I'll sell at a 6% cap rate, okay? And, people kind of hide behind this type of rule of thumb model saying, well, I'm being conservative, therefore my underwriting model is very good. The reality of it is your underwriting model is bullshit, okay? It's not worth the Excel spreadsheet that it's been written upon. The reality is, where are you pulling this expansion of 10 or 20%, 10 or 20 basis points per year? What are you basing that off, right? That's what anyone should be asking. What are you basing this off? Well, I'm being conservative. How do you know you're being conservative?
Yep.
How do you know you're not being optimistic, right? You could actually be very optimistic with that, and conservative might be an increase of 0.25 a year, right? The reality of it is that everyone underwriting deals right now, they're not basing their inputs off any data, right? And they're definitely not basing it off any predictive analytics, because it's one thing to have the data, the historical data, but just because you have historical data doesn't mean necessarily that's going to repeat itself in the future. That's why we have predictive analytics. So let's say that based on historical data, your 5% acquisition cap rate should actually be a 5.5 in 5 years. Now, the problem with that is that history is never guaranteed of the future, right? So that's why you then have to plug in various scenarios where you're considering this. And that's where predictive analytics become very difficult, because you're pretty much just kind of taking a shot in the dark and basing things off the past, but you're putting in like a margin of error. With machine learning and artificial intelligence, you're able to make your predictive models better ex post based on ex ante results. So let's say you create a model to predict the future cap rate. Well, you want to predict the future cap rate in 5 years if your goal is to sell within 5 years. Well, if you predict that today, the probability that your 5-year cap rate from now is going to be precise is a lot lower than, let's say, in 4 years you predict the cap that same cap rate, right? Because you'll be closer to your exit. So there'll be less room for margin of error. So what machine learning and artificial intelligence will allow you to do is to consistently kind of reset your model as time advances. So maybe your initial model based upon acquisition was off. But as you advance in time, the artificial intelligence and machine learning continues on training that same model, the same algorithm that you had, and adapts the various inputs and algorithms to make it more and more precise as you get closer. And on top of that, as you get closer, the range of distribution of probabilities gets smaller. So it's a double effect. Your predictive model gets even tighter and tighter as time goes by. And that's where machine learning and artificial intelligence can really help out, is that instead of just plugging in these ridiculous exit cap rates and ridiculous growth rates and ridiculous inflation of expenses and absolutely ridiculous refinancing interest rates, well, we get closer and closer to being able to actually put in inputs that are based on something very, very solid, and then therefore our underwriting models will become more and more precise. And what we want in underwriting when you're buying a property, whether you're a syndicator and you're responsible for money of your LPs, or whether it's your own money, the goal of underwriting is not to be conservative. That's not what the goal of underwriting is. And anyone who says that they underwrite and their underwriting is conservative, what they're really telling you is they don't know how to underwrite, okay? You don't want to be conservative. You want to be right on the dot. That's what you want to do with underwriting. You want to be as precise as possible, because the reason that you buy the property today is you buy it for future cash flows. And cash flows can come in various ways. They can come in annualized cash flow, so free cash flow. They come in the appreciation of the asset, so the value that that asset gains because of various market dynamics and because of the way you're managing that property. And they also come through the capitalization of your mortgage. So there's part of your mortgage that you're paying down, which is principal, right? So those are the three cash flows that you can receive. Now, when you're underwriting a deal and you're looking at how much you should pay for, say, this 100-unit building you're looking at, well, if your inputs are off, you might buy that property, but it's a bad acquisition because you were too optimistic in your inputs. But it also happens that you were too conservative in your inputs, therefore you didn't buy the property. Because if you inputted that the exit cap rate on that property is 7%, but in reality, 5 years from now, the exit cap rate is 5 3/4, well, guess what? You missed one hell of an opportunity. Correct. And in real estate investing, the most important thing is time value of money. We only have a very limited time during our lifetimes in which we can invest and create wealth. And we only have so many hours during a day. Therefore, the cost of opportunity and the time value of money are the things that we should consider the most in our underwriting. And that's really where machine learning and artificial intelligence will help investors become much, much better. Obviously, you also need education, right? You have to understand these. I mean, this is advanced stuff, and I'm trying to kind of explain it in a simple way where people who don't have master's degrees and PhDs in finance and engineering can understand it. But the reality of the matter is that multifamily investing is it's a very complex, it's a very sophisticated asset class, and you need a certain level of education. The problem being right now, despite the very high level of education that some investors have, we just don't have solid predictive analytics tools and data to be able to make sure that we're actually able to transfer our education into decent acquisitions.
Yeah, well, that's very interesting because exit cap rate is always being misused or misconservative, right? So,
well, even entering cap rates, even acquisition cap rates, I see people saying, "Well, I'm not going to buy that property because it's a 5 cap rate and the market's trading at 5.5." Okay, is that a stabilized property? No, it's a value add property. Well, the cap rate is meaningless then.
Yeah.
A cap rate is a metric of a stabilized asset. If the asset is not stabilized, there is no cap rate, because a cap rate is a perpetual annuity. It's a return metric based on an unlevered perpetual annuity, which means the same cash flow every year forever.
Correct.
Now, if you want to be able to calculate that, your property has to be stabilized. So if you're not buying a property because it's a 5 cap rate and the market's trading at 5.5, but it's a value add deal, well,
I'll buy it all day long.
I'm sorry to tell you, you should change fields. You should go play. You should go to Las Vegas and put it all on red.
Well, not only that. I mean, not only new investors doesn't understand the entry cap rate doesn't matter, the value add deal, and I don't know. I never see a reason to do a stabilized deal, not on commercial, right? So, for me, I'm always a value add guy. That's why I named
it. Well, unless you're a private equity firm or you're a family office or you're a REIT or you're an ultra high net worth individual who now has a net value of anywhere between $10 and $150 million, there's no real reason to do stabilized deals, right? The reason you want to do stabilized deals is because you have a very high net worth, or because you're trying to de-risk your portfolio, right?
Correct.
That's why you would do stabilized deals for a small cap or mid cap investor.
Yeah. Most of the time, I mean, commercial is always a value add play. I mean,
of course.
I mean, there's a lot of people doing stabilized deal nowadays just by getting higher mortgage or getting slightly lower price play on the mortgage side with the interest to get some cash flow. But
that can work if you're a neurosurgeon, right? If you're a surgeon making $1.5 million a year and you're 35. And you say, well, I want to start buying multifamily property because I like real estate and I like the tangible part of the asset class, but I don't need any money right now because I'm making $1 million, I'm making $1.5 million a year. I don't need any cash flow, and I'm very long term, and I just want to build myself a nice retirement, because that's what I want as an objective. Well, then yes, buy stabilized property. Or be an LP in a syndication, or purchase a stock in a REIT. That's fine. But if your goal is to increase your wealth exponentially in a short period of time, and what I mean by short period of time is 5 to 15 years, well then, you're going to have to do some kind of value add deal. You can't just do financial arbitrage all the time.
Yeah. There's a lot of deals out there in different asset class which can give you that cash flow, right? I mean, you can buy a stabilized mobile home park. It'll give you higher cash on cash than any multifamily deals.
Right.
So even self-storage or even multifamily which has been stabilized, you'll get good cash flow. But how long will that cash flow be guaranteed? Because you have a very tight DSCR at that point of time, and let's say the market turn, you may not your DSCR might be compromised right now, right? Because you don't have any buffer.
Especially if you did not properly manage the terms of your mortgages, right? So if that's very dangerous. Like if you feel that the market's going to shift, say interest rate wise, the easiest way to kind of play yourself out of the situation you just talked about is just take longer term mortgages. Make sure that the mortgage does not end in 5 years. Make sure it's a 10-year term or even maybe a 30-year term, right? That's the easiest way to manage that risk.
Yeah, just do a HUD loan, right, which gives you like 30 or 45 years. I mean, there's the other trick that a lot of people play is, showing only cash on cash based during IO period. And nowadays people are getting 5 years, 7 years IO period. And sometimes people think, I would not hold, that deal for long term. I mean, you are hoping on not holding, right? But you do not know what's going to be happening to the economy, right? So
it's a dangerous game to play. And I'm not saying don't play it, but make sure that you have make sure you have the education and the know-how to be able to manage that risk. It's all risk management. Ultimately, that's what it is. Right?
Yeah.
The problem is a lot of people are doing this and they don't know what the hell they're doing.
Yeah, I mean, I think there's so much of capital out there right now looking for money to be placed in somewhere, and
definitely.
People do not think that, rather than I'm putting 1% in the CD, I might as well put here and get like 6-7%, right? Cash flow, right? And
that's the retail market. Like that's small investors like me and you. The reality of it is the real capital flow right now is at the institutional level. Mm-hmm. There is so much high level money and smart money searching for returns right now. I mean, we can't even fathom it as small investors, how much money. I mean, family offices typically, if you take the family office market, typically always allocated maybe like, I don't know, depending on the family office and the region, but usually anywhere between, maybe 8 and 12% of their overall asset allocation, capital allocation to what they call alternative assets, right? Okay. And real estate is part of alternative assets. Now, over the last 10 years, the last decade, family offices have become more and more in tune to the real estate markets. High net worth families also, especially towards like multifamily real estate. And more, real estate is no longer considered just as something under the alternative asset umbrella, but now it's kind of becoming its own umbrella. And what that's doing is that instead of family offices, and we're talking about family offices that have trillions of dollars, right? Mm-hmm. These are not small things. These are big moving bodies with a lot of capital. We're talking about billions of dollars, not trillions, multi-billion-dollar family offices that are now, instead of allocating 8% to real estate, well, now they're allocating 20% to real estate. So, and that's at scale. Like there's a lot of them out there, and we haven't even talked about the private equity firms. We haven't even talked about the pension funds, the international pension funds. People talk about globalization and international money, thinking that it's just rich Russians going to Sunny Isles, Florida, buying $10 million condominiums. That's not what it is. The global movement of money to American and Canadian real estate are things like the Amsterdam teachers pension fund or government workers pension fund, allocating $100 billion to the American real estate market. Now that puts a big dent on the supply and demand of real estate, and that's what ultimately drives property values much more than interest rates. Interest rates only influence property values. Like people were talking about, especially in the last couple of years, if interest rates go up, cap rates will follow and they'll go up. That's not true. Capital flow drives cap rates and values of properties in multifamily. Interest rates only influence cap rates and values.
Very interesting perspective. That's you're right. There's so much money, even out of United States, is looking for money to place, right? Like the other day I can call from UK. There's a family office who want to invest in UK, and they're looking for like operators like me. And I was asking them what's their return expectation. They say there's 22% IRR, 20% IRR. I said, well, I don't need you guys. I can get that money in the US, right? So,
right, exactly. And all the money from the quantitative easing that followed the 2008 crash. I mean, all that quantitative easing money, a lot of it still, after even 10 years, has not even found a place for it yet, right? So there's a lot of money chasing deals.
Correct. That's true. So coming back to the exit cap rate, so I know that's one of the hardest parameter to measure, right? So,
absolutely.
But can you clarify again, how would you use artificial intelligence to find a more accurate exit cap rate? T minus 5, like T minus 5 is 5 years earlier before you hit the 5 years mark of selling, assuming 5 years is selling.
So it's the computing power, right? So it's a computing. What we do is like we'll build. So we'll build. Say, I'm sorry for anyone who hasn't studied, high level university finance, or statistics. We'll build a regression model. So we'll look at past data. We'll plug all that in, in order to build a predictive model, a future model, being able to come out with future cap rates. And the more data that we're able to plug into our regression model. So historically, what real estate statisticians and economists have used is what they call the linear regression model, used in Monte Carlo simulations. Now, the problem with the linear regression model is that past transactions or data are also affected a lot by various things like political environment and capital markets, and there's a whole bunch of factors. So there's a new model that's being used more and more, especially with a lot of postdoctoral students in statistics. It's called a quantile regression model. So that's where we're able to create that same kind of, and I'm saying this in layman's terms as much as possible, where we're able to take past historical data, build that kind of linear model, kind of like build that line chart for people to understand, and we kind of repeat that line chart in the future. But we're also able to start to weigh those data points with various things like a new government, with quantitative easing, with all these, with the war, with various factors that maybe affected that models to make it less linear, and then we're able to start to better predict future stats and future cap rates. So that's the first step of it. Mm-hmm. The second step is, let's say right now we've built our quantile regression model, and now we compute it. And what it says to us is, well, T-5 cap rate, so 5-year cap rate is going to be between, let's say, we have a couple tracks. It's hard to explain for people who have not done statistics, but we have a couple tracks, and ultimately, what it says is that the highest probability is that cap rate's going to be between 5.75 and 6.10% in 5 years for that specific market. Now, like I said, as we get closer to the 5-year period from now, the less the margin of error is, right? Because we're closer, and multifamily market moves very slowly, right? So predicting, the easiest way to understand it is predicting 25 years out from now is very hard, right? Mm-hmm. Your 25-year prediction is going to be way more, there's more room for it to be completely off than your 2-year prediction.
Correct.
So we built a model for the 5-year prediction. And then starting tomorrow, every day, our artificial intelligence recalculates that model. So as it recalculates it, the model gets more and more precise, because let's say we took statistics from today to 20 years ago. Let's say we took the cap rate of that market starting from today and 20 years back. Well, obviously, the last 20 years, the next 20 years are not going to be exactly like the last 20 years, right? Mm-hmm. But that's ultimately what statistics do, right? We try and kind of say, well, let's take the last 20 years. There's a margin of error, and that's what's going to be the next 20 years. So what's cool with the artificial intelligence is, without actually having to do anything, every day the artificial intelligence kind of brings the model a day closer and adapts the model with more and more weight on what's going on right now rather than what happened 20 years ago. And it also is able, the artificial intelligence is also able to measure what today it predicted for yesterday versus what actually happened. And what's the spread in difference and what caused that spread. And therefore, once it's able to determine what caused that spread, it'll add that into the equation for the future cap rate model. So it becomes much more precise.
Yeah, but don't you have to run it in iteration on a daily or monthly basis towards the whole investment process? But how do you make it on day zero, where like today, when I'm buying today, how does it iterate then when on a day zero?
Well, what do you mean? Sorry, I don't understand the question.
So my question is, you said the data is being fed into the system, right, to get a more accurate exit cap rate, right? But you're making a decision to buy today. Is the iteration happening from today throughout the investment cycle, or do you do it earlier before you decide to buy a deal?
Oh, you mean, okay, yeah, I understand what you mean. So like for determining your actual purchase cap rate.
Correct. No, not
Right.
purchase. Yeah, whatever price that I'm going to pay today, because that's what I'm getting into the deal, right? That's the point of me making a decision whether this is a good deal, and I'm going to be raising money and telling everybody this is a good deal.
Right. Well, I mean, determining the purchase cap rate is a whole other set of statistics and data models. That's more, I'd say, determining today's cap rate is much more an endeavor of collecting more historical data, right?
Mm-hmm.
Because, like I said, let's say JLL, Jones Lang LaSalle, which is one of the biggest brokerages, they come out with reports and say, okay, well, the cap rate, let's say in Austin is 5.2%. Let's say the mean cap rate is 5.2%. Well, that's based on maybe like 30 or 40% of actual transactions that happen, because they don't have data on like the off-market transactions or the pocket listings or this and that, right? Mm-hmm. And on top of that, they haven't normalized the cap rates on whether, let's say a building traded at a 4.6 cap rate. Well, like we said, if that property wasn't stabilized, well, then that cap rate is off, right? That's not a good cap rate. So that's a second thing. So for establishing what you should pay today, what's the intrinsic value today? That's ultimately what I think the question is. And correct me if I'm wrong, but let's say you're looking at a 100-unit property. What is the actual intrinsic value of that property? What's the real cap rate I should be buying at? Well, that's a question of having the proper volume of data. Okay, number one. So that's what we're working on right now, is making sure we keep on building our database, so that instead of our market cap rates being based only off 30 or 40% of inventory or transactions, well, it'll be based off maybe 60, 70, 75%. Therefore, that cap rate becomes more precise. Secondly, we also we actually look at every transaction and say qualitatively, because that's the first thing is a quantitative aspect, right? In statistics, we have quantitative and qualitative. Mm-hmm. So the quality of the data, once we have the quantity, we look at the cap rates and say, okay, that property traded for a 4.2 cap rate. Was that a stabilized property? No, it was not. Okay. Once we add the CapEx, we have the new revenues, and we adjust the sales price for CapEx, but we also adjust NOI. Now we can look at the stabilized cap rate. So that's the qualitative aspects of it. And now we're able to say, here are the market cap rates. Here's the low end of cap rates. Here's the high end of cap rates. Here's the mean or the median. And here's that range of cap rates, right? Because cap rates are based off the cap rate calculation ultimately, even though people think it's NOI divided by sale price, which is not true. That's not what a cap rate is. That's how you find the cap rate of a sold stabilized property. The actual cap rate calculation or formula is a mathematical equation of R minus G. It's algebra. So R being return minus G, which is growth. And R is defined as RF plus RP. So the risk-free rate plus the risk premium that you as an investor are looking for, or that the market is looking for. A perceived risk premium, obviously. So what we want to do then, and that would be like a third step, and we're not at that level right now, but I hope within the next couple of years we will be. Mm-hmm. And I'm sure you as an engineer are probably understanding how valuable our ability to do that would become for the market.
Yes.
Is that then you're starting to be able to say, well, right now that property is being listed at let's say the range for cap rates in Austin is really 5 to 6. Obviously, 6 is going to be in the worst neighborhoods, right? And 5 is going to be in the best neighborhoods, because it's a matter of risk, right? Well, then you're looking at the property. Let's say it's at a 5.7 cap rate, but it's kind of on the limit of a bad neighborhood, good neighborhood. And then you're able to intrinsically say, but the intrinsic cap rate of that property, the real intrinsic value of that cap rate, is actually 5.3. Now, if you didn't know that, and you just said, well, the average cap rate is 5.7, well, you'd say, well, it's not much of a deal. I'm not going to buy that property, right? But now with this new data, what you're able to see is, wait a minute, it looks more expensive than what it should be. But in reality, it's not. It's actually cheaper because the real intrinsic value is a 5.3 cap rate. And that would really unlock the potential of what we call value investing, what like a Warren Buffett has built his entire career off in the stock market. Well, he was able to build that. Value investing exists so much in the stock market because of the quantity and the quality of the data, right? The quantity of the data is accessible to everyone. The quality of the data is a bit harder to get, the qualitative aspects. That's why Warren Buffett has been such a great investor, because he invested so heavily into being able to pull out the qualitative aspects of the data. Well, now we would be able to do the same thing. You would be able to do the same thing as a multifamily investor, and you would have access to the quantity of data needed for you then to increase your knowledge based on the qualitative aspects of it, and then be able to properly price that acquisition. And then once you're able to do that, well, then you can go and say to your investors, look, this is why I'm buying this deal, right? This is why it's a good deal. And if on top of that, you're able to be more precise with your exit cap rate and the growth rates of your revenues and expenses and your refinancing rates, well, you're going to be a much more confident investor.
And you're making a really,
it's a more efficient market.
It's a more efficient way of actually determining your purchase, right? Because
of course,
yeah, you can't really just say generally, okay, Austin is 5 cap. It's not true. There are different markets, sub-markets too, right?
It's kind of scary to say, but we're all kind of investing in multifamily kind of half blindfolded, right?
Blindfold, yeah.
The guys like me and you, and there's a whole bunch of other guys out there, really intelligent investors, we're all investing based on intuition, experience, a very strong knowledge base, but we're ultimately kind of investing with one eye closed. Now, it's even worse for people who don't have a knowledge base and experience, because they're all investing completely blindfolded, right?
Interesting. So yeah, if you can get that kind of data where you can look at the sub-market and what's the potential, especially if it's in the path of growth, right? And what's the risk that you're buying, right?
Right.
Because there's some deals, even though you buy it at the lowest cap rate for that market, it could be still the best growth, because it could be just like another big explosion in terms of jobs going to be happening in that area just because of the path of growth.
And that's so important, because if in your pro forma on your underwriting, you predicted a 2% growth rate of revenue, but in those 5 years, the annualized growth rate was 6%. Well, you probably didn't buy that property, right? But you should have.
Correct.
And the other thing is the same. If you predicted a 6% growth rate and it was 2%, well, then you bought that property and you shouldn't have, right?
Correct.
But you know, what most people will say is, well, the guy who predicted 6%, he should have put in 2%. Like, he should have been conservative, right? That's not necessarily true. That's a half truth. That's actually a mistake in logical reasoning, because the other guy who says, well, I'm going to plug in a 2% growth rate because that's what historically happens. Well, what happens if you invest in a market where the growth rate is actually 6%, right? And that the other intelligent investors knew or predicted that it would be 6%. Well, they're willing to overpay, according to you, for a property. And then you end up not buying anything. You're not generating any returns. You're not building your wealth. And you're just kind of sitting on the sidelines there, bah humbugging, saying, well, the market's paying way too much for the properties. And, these guys are stupid money, blah, blah, blah. I'm going to wait for the market to crash and blah, blah, blah. Hey, I know guys who've been saying this since 2012. And they have not bought anything since 2012. They haven't generated any returns, all under the pretext of being conservative investors. You know what? They're not conservative investors. You know why? Because they're not investors. Because they haven't bought anything. Because they played themselves out of the market and they're sitting on the sidelines. And they're just making up for a lack of precision in their underwriting through, this kind of pseudo conservatism.
Yeah. Well, I think it just depends on the sophistication of the investors, right? If you look at nowadays, multifamily has become so popular. So many people who did not have the financial education background or the way to analyze a deal, right? There's a lot of parameters that goes into any deals, right? That's Absolutely. What you mentioned. You mentioned so many parameters. Nobody really look at that, right? Everybody said multifamily is good. I'll buy it. And it went 300%. And they said, oh, I'm a really good operator. Well, actually, you should have made 500% because the market gave you at least 400%. And
Amen.
100%, right?
Amen.
You just did 300%. Why did you do 300%, right? So,
amen. And that comes down to what we call the search for alpha, right?
correct.
You want to outperform the market. And all of these people, and there's a whole bunch of them now. They're gurus and mentors and coaches, and they're giving all these online classes or seminars or whatnot, or they're boasting about being such great real estate investors. And the reality of it is they don't even know what they did. They're like, well, I generated X percent returns, and I've created X amount of millions of dollars in profit over the last 5 and 10 years. Yeah. But that's actually quite average. That's what the market did. As long as you were in the market, of course, that's what you generated.
Correct.
Now, did you generate more than what the market did? That's the real question, right? And unfortunately, there's not enough people in the market asking that question. And if you're a passive investor, that's the question you should be asking your syndicator or your GP. Is not, oh, this is what you generated. Great, that sounds awesome. You generated 22% IRR annually over the last 5 years. What did the market generate?
Yeah. Correct.
Oh, the market generated 23. Oh, so you're not that great.
You're not that great. You I remember the other day I saw someone. He said, "Oh, I made 60% in 1 year. I bought it in first year. I bought it and I sold it in 12 months. I made 60%." I said, "Well, you should have made like 100%, no?" So
exactly.
So the market went up by that much, right? So,
and that's why I'm so bullish on education, and why I think it's so important that multifamily investors get educated and push their knowledge base, because we're not this is not Nintendo, this is not Xbox. We're not just playing baseball on our PlayStation 3 or PlayStation 4. Mm-hmm. This is serious business, and even more so if you're a syndicator. And I just think the knowledge base needs to continuously be expanded, and it's not. And that's why data also needs to be there, because knowledge without data is also quite useless.
Correct. So coming back to your being the alpha in the market, right? So, I know you can look at different market appreciation versus how much you are making money, right? So coming to, let's say, for a decision where you have a deal in your hand and you're deciding whether you want to sell or you want to refi or 1031 exchange, right? So can you give us a good methodology to make that decision?
To make the decision on whether you beat the market, or
whether you want to sell a deal, or whether you want to refinance, or whether you want to hold it for long term, or you want to do a 1031 exchange, how would you approach it?
Well, I'd approach it on a very individual basis. Number one, I think everyone has a very different investor profile. Mm-hmm. So, and what I mean by investor profile is what type of returns do you want and when? What are these strengths and weaknesses that you possess as either an owner operator or a syndicator or whatnot? What access to capital do you have? How patient is that capital? What's the cost of that capital, right? Now, if it's your own money, obviously it's probably going to be the most patient money with the cheapest cost of capital. If you're raising money from other people, well, then obviously there's a less patient aspect to it, and the cost of capital is going to be higher. If you're taking money from bridge loans, well, that's even worse. And if you're taking money from hard money lenders, well, then obviously your cost of capital is going to be very, very high, right? So these are all things that you have to consider. You also have to consider where you are in your career with regards to what it is that you want to achieve, either as annual cash flow or just overall net value, and what type of risk you're willing to accept, right? So ultimately, you have to be able to answer those questions initially to be able to decide on the strategies, because ultimately, people in multifamily investing, what they do not understand is the difference between philosophy and strategies. Okay. Now, everyone should have their own investment philosophy based on their investor profile. Now, once you have that philosophy, what you want to do is adapt your strategies according to where you are in the market and where you are in your career. Okay. And that's something that is very misunderstood. People say, I'm a buy and hold investor. Okay. We hear that a lot in multifamily. So ultimately what you're saying is that you do not have an investment philosophy that you think you do, right? You think your philosophy is buy and hold, but buy and hold is not a philosophy. It's a strategy, okay? So what you're saying is ultimately you're investing all the time throughout the whole of your career using just one strategy. Now that's very dangerous, because let's say the exit point of that strategy eventually, say the day that you do have to sell upon retirement, because even though you're a buy and hold, you might not be a legacy buy and hold investor. What I mean by that is a legacy buy and hold investor is someone who's just going to pass down the properties to their children, right, upon death or upon retirement. Whereas most buy and hold investors, what they really mean is, I'm going to buy and hold until my retirement, and then I'll start selling off, right? Well, what happens if during your retirement you're in a trough in the market cycle, right? What if you're at that part of the market cycle where you're at the bottom of it, and it's a really bad time to sell? Well, that's the mistake of always investing using only one strategy. So what I would say is that you have to adapt, you have to establish your philosophy, understand that your investor profile is going to change over time, and that the market cycle moves through phases. There are different phases in the market cycle, and your strategies, you have to be able to use different strategies at different phases of the cycle and at different phases of your career as your profile changes or adapts or morphs. And that's how you then establish, well, with this property, should I buy it and hold it, or should I sell it? Or should I just refinance it? What should I do? And I'll give you a very concrete answer once I've explained all this. I have a student here, because I do teach real estate investing courses. We actually built a college. We call it the College of the MREX. Now, you don't have to, it's not college level education, but what we're saying is that for everyday multifamily investors, if you really want to learn college level stuff without having to go to college, well, we have a couple courses that we teach you, very high level stuff, very concrete. You still need coaching from coaches and mentors and all that stuff. We actually teach courses, right? But so one of my students in these courses, he's a very successful real estate investor in Montreal, in Canada, which is Montreal is the most important multifamily market in Canada. It's a very strong multifamily market, very competitive. Now he was up to about, I guess, 150 units, right? All on his own, no outside money, no passive money. And he started having trouble refinancing out of his properties, because what he was doing is he was a very big value add investor. So he was using two strategies, value add and buy and hold, right? But he was erroneously thinking that value add and buy and hold was his investment philosophy, right? Which it's not. Those are two strategies that are part of a philosophy. So he came to me and he said, well, look, banks have now started to tighten their DSCR ratings and their LTVs. Therefore, I'm buying a property at $1 million. I'm putting in $300,000 into it. And now the market value of that property is $2 million, right? But I'm not able to refi at $2 million because of the banking standards. They're only allowing me to refi out of 1.6. So now if they're letting you refi out of 1.6 on a 75% LTV, what they're saying is, well, you have to leave in 25% of 1.6 plus $400,000, right? Mm-hmm. So that's a lot of equity that he's not able to pull out because he was doing too much of a good job at value add. Mm-hmm. And the capital markets, the banks, are not being able to follow market value. Banks, especially in Canada, are much more conservative than in the U.S. But even in the U.S., there are a lot of people buying properties, and they're not able to refi the whole value because their total loan dollars are blocked by either LTV or DSCR, what I call economic value. The economic value is not as high as market transaction value. Therefore, instead of leaving 25% of equity, you're leaving 25 plus, in his case, $400,000. Now, that's where I said to him, perfect. I looked at his portfolio and I said, well, you have to adapt your strategies. You have to change the strategies. You can no longer at this moment use the buy and hold strategy. You have to use the fix and flip strategy now because you're too good at fixing value add and you're not able to pull out as much equity as you used to be through refinancing. Therefore, now you have to seriously consider selling that property because you can go and get $2 million for it on the market right now. So that's an extra $400,000 because he was able only to refinance 1.6 out of it. So now he's able to get the full market value, pull that cash out, and he has access to a lot of opportunities. He has a really strong bird dog network. So his cost of opportunity is very high if he's leaving all that equity in these properties that are all stabilized, right? He's making way more money by doing more value add stuff. So he made the decision, and now he holds 0 properties. He has sold all his 140 units because that has allowed him to get more and more cash rich, leave less and less money in equity in properties, and gain access to more and more opportunities. And ultimately, his annual portfolio total return on investment is in the 40s to 70% IRR, whereas while he was doing buy and hold, his overall portfolio was only returning him maybe 20% if you consider the weighted average return on investment. So that's how I would attack kind of that problem. I know that's a very long-winded answer, but that's
no. I think that's the right answer, right? So I mean, the return on equity, which is debt right now. I mean, on his deal, right? There was so much of debt equity not producing cash,
right?
And if your cost of capital, which is also equivalent to opportunity outside, is much higher, you might as well just cash that out by selling it off, right?
Right, because the refinancing is leaving you too illiquid.
Yeah. Recently, I mean, the banks has been more stringent on refi, right? So the last refi I did, they did ask me to leave 5% my cash basis, which they never did in the past. Which things have changed. I think that's okay. That's how the banks work, So
it's okay, but the problem is that on a $50 million property, that's $2.5 million less cash you have for the next acquisition, right?
Correct. So yeah, I mean, it depends on what is the cost of capital outside, plus how much you can pull out and how much your equity is stuck on it. So coming back to market cycles, because I think this is one thing that I want to ask you, because I think you have studied with Dr. Glenn Muller. So right now, if I look at the latest Q1 forecast for apartments, we are in the hypersupply market. I don't know whether that's something that you are aware or not, but
nationally, right?
Nationally, yeah, it's not a local, but a lot of markets are in hypersupply, right? There's very few markets as the expansion cycle, and even though they are in the expansion cycle, they are the last stage of expansion cycle, right? And all the markets that's on expansion cycle are the markets that recovered late, like Las Vegas, Phoenix, and a lot of that kind of market. So can you give an overview on what do you think the market is and what should be the strategy be for investors now?
Well, I think number one, I would say that I try not to look at national or macro market cycles.
Okay.
I think that's the first thing to consider because multifamily real estate is so hyper-local.
Okay.
So I'd look much more at those market cycles of of hyper supply and expansion and contraction. I look at more of like in a metro area. So like you're in Austin, Texas. I'd look at Austin. Right? I wouldn't really consider the multifamily market at large because it's just too, it's kind of like looking at cap rates on an unstabilized property, right? It's it's kind of a waste of time. Now. I'd say that I haven't looked at recent data of where all the markets are in the phases of the cycle. But I mean, I think it is safe to say that most of the markets right now are in the later phases of the game, or later innings, as Howard Marks likes to say in the stock market and capital markets. But also, as he says, we don't really know. See, the thing with market cycles, and whether it be with Dr. Mueller, whether it be with Kieran Trass out of Australia, and out of also the other various professors and researchers in market cycles, is that they are predictable in the sense that we know the phases of the cycle, and each cycle pretty much rhymes, but they're not exactly the same, and we never know what the inflection points are going to be between the phases, how intense they'll be, So let's say you go from the hyper supply in a market to the contraction phase. Well, that might be a very small, that might be a very weak transition. There might not actually be that big of a difference, right? It's not like necessarily the cap rates are 5% in Austin, and then all of a sudden in 6 months the cap rate's going to be 7%, right? And that's not how the multifamily market works anyway. It doesn't move that way. It's not the stock market. We don't have daily trading on fractional stocks, so it's not as volatile. And because a very important portion of the market in multifamily is majority buy and hold. Well, even though the market does change, they don't move. Therefore, the market doesn't move that much, right? So what I'd say is to not be over indexed on where we are in the phases of the market cycle, but to just kind of be aware of it, because what you can then do, and as I said, we don't know how intense the transition is. We don't know how long each phase will last, right? Mm-hmm. We might go into contraction. It might only last like a quarter or 2 quarters, right? And it might, transition out of that quite rapidly. So that's the other thing to consider. So what I'd say is, if you're underwriting a deal and you're in the oversupply phase of the cycle in the city that you're looking at, well, then I'd try and be conservative, and not that airy-fairy conservatism that we were talking about earlier, right? Yep. I just try and be more conservative if I'm not sure of the deal and I'm kind of on the fence. Well, if I'm in oversupply right now, I might not do the deal, right? Or I might decide to oversubscribe my deal, or to have more cash reserves in case the market does transition, right? Mm-hmm. So it's risk management at that point. That's the way I see it. You never stop buying, okay? You never stop being active in the market. If you do, then you're not an investor. You don't know how to invest. You don't know what you're doing. An investor must be invested and is always investing. And an investor is ultimately a risk management. So it's just your risk management that changes. You want to be less aggressive. Now, it's the opposite. If you feel that now you are at the end of the contraction phase of the cycle and you're kind of on the fence for a property, well, then I'd jump into it even more. I'd be more aggressive on that acquisition. I'd fight maybe a bit harder for it. So that's kind of how I would modulate my decision-making and the parameters that I would use. I'd modulate the aggressiveness or the conservativeness. I'd also modulate the amount of capital I actually go into the deal with. I buy in a place where I think the market's going to downturn. Well, obviously, I might use a bit more less leverage. I might use less leverage. I'd keep a lower LTV and a higher DSR. I'd keep a higher cash reserve just in case, and I might also do a longer term on my mortgage, just so I don't end up with having to refinance in 5 years in the middle of a poor capital market or a property market.
Yeah, awesome answer. So Nikolaï, I think it has been quite some time. So thanks for coming for the show. You want to tell the audience how to reach you and about you and MREX and your process?
Absolutely. You can reach me on Facebook. I'm quite active. LinkedIn also, and Instagram. Nikolaï Ray. There are not hundreds of me, so there's only one. Also, you can go on the website of the MREX. If you type MREX in Google or www.mrex.co, make sure you press on the English tab, because part of the site, the site is in English and in French because part of our business is in Canada. And I will be present at the Multifamily Real Estate Week in July in Jacksonville, Florida, which is going to be an amazing event. So if anyone invests in that market or is around Florida, you should definitely be there. And I'll also be back at that event, the Multifamily Real Estate Week, in Tampa in August and Orlando in August. You can find all the information on the MREX's website. And I hope to have the chance to speak to some of your listeners at one of those events. So,
great. Thank you very much, Nikolaï.
Thanks a lot. It was really a pleasure talking to you.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.